Hello, everyone. As we get deeper into our study of taxation, we start running into these rules that, well, they don't always seem to follow simple logic, right? Today, we're going to tackle one of the most important and interesting of those rules.
All right, class, let's jump right in. We're looking at a topic today that is absolutely fundamental, but it's one that catches a lot of people off guard. It's the gain on settlement of debt. Now, on the surface, it sounds super straightforward, doesn't it? A company owes money, they settle for less, boom, they're ahead. But, and this is a big but, the way our tax system treats that gain is, let's just say it's very specific. It follows its own unique set of rules. So that's what we're going to do today, break that whole process down step by step. Okay, so here's our game plan. First, we'll figure out what a forgiven debt even is. Then we'll dive into something I call the application waterfall. It's how we have to apply this gain, first to losses, then to reducing assets. We'll see what happens with anything left over. And finally, we'll tie it all together with the big strategy here, which is really the art of deferral. So, first things first. We have to nail down what we mean by the initial gain. Getting this right is the critical starting point, because if we don't, none of the other rules will make sense. It's a huge deal for any business that's dealing with, financial tough spots or even looking at new opportunities. So what exactly are we talking about here? Well, just picture this. You've got a business, and maybe it's struggling a bit, so it goes to the bank and renegotiates its loan. Or think about this. A supplier offers them a huge discount if they pay a big invoice early. In both of those scenarios, the company settles its debt for less than what they originally owed. That difference, that bit of money they saved, that is the gain on settlement of debt. To make this really concrete, let's follow an example all the way through. Let's talk about a company called Innovate Corp. They've got a $100,000 loan hanging over their heads, but through some smart negotiation, they managed to settle the whole thing for just $60,000. Now, the math here is pretty easy, right? That's a $40,000 gain for them. So, here's the million-dollar question. What happens now? What does the tax system do with that 40 grand? And this is where things get weird. You might think, okay, $40,000 gain, that just gets added to their income and taxed, right? Nope, not at all. Unlike the money you make selling a product, this gain does not immediately get taxed. The Income Tax Act has a very, very specific playbook we have to follow, and let me be clear, this isn't a choice. It is absolutely mandatory. Okay, and that brings us to what I call the application waterfall. I really want you to get this picture in your head. Imagine that $40,000 gain is like a bucket of water at the top of a waterfall. It has to flow down, but it has to fill a series of pools in a very specific order. It can't skip any. And the very first pool it has to fill up, that's any losses the company might have. So yeah, the very first stop for our gain is to wipe out any losses that the taxpayer has been carrying over from past years. So what does that mean? Well, it means the gain isn't taxed right away. Instead, it gets used up to cancel out these old losses. Losses that, by the way, would have saved the company money on taxes down the road. This is our first real hint of what this is all about, tax deferral. And here's a crucial point, so listen up. You do not get to pick and choose which losses to use. The law lays out this exact order, and it's non-negotiable. You have to start with non-capital losses, then go to farm losses, and so on, all the way down the list to net capital losses. For anyone planning on passing my exam or, practicing in the real world, you absolutely have to memorize this sequence. Okay, let's get back to Innovate Corp and see how this works in practice. They have their $40,000 gain. Now, let's pretend they also have a $15,000 non-capital loss they've been carrying forward. Well, the first $15,000 of their gain just poof gets used to wipe out that loss. So now they're left with $25,000 of the gain. Following our mandatory list, let's say they don't have any farm losses, but they do have a $10,000 net capital loss carryover. So the next $10,000 of the gain gets used up on that. After this first big step, that original $40,000 gain is already down to just $15,000. So all the losses are gone, but we still have $15,000 of that gain left. What happens now? Well, now we move to the next level of our waterfall, which is all about reducing the cost of assets. Now here's a big change. At this stage, the taxpayer actually gets a choice. This is what we call an election. They can choose to apply that leftover gain to reduce the tax cost of their assets. This could be depreciable stuff like buildings or equipment, or it could be capital assets like land. And the consequence is really straightforward. If you reduce an asset's cost base today, it just means you'll have a bigger capital gain and more tax to pay when you eventually sell it down the line. Let's check back in with Innovate Corp. They've got $15,000 of gain left, and it turns out they own a building. They can make an election here. and they decide to use $10,000 of that remaining gain to reduce the building's cost base. So the gain is now down to just $5,000, and, importantly, the tax cost of their building is now $10,000 lower. And this is where the strategy really comes into play. If you have a choice, which asset should you pick? Think about it. The really smart move is to pick an asset you're not planning to sell anytime soon. By reducing the cost of, say, a building that you're going to own for the next 30 years, you're essentially kicking that tax can way, way down the road.
Okay, so we've gone through the losses, we've made our elections on the assets, but look, in our Innovate Corp example, there's still $5,000 left over. This brings us to the very bottom of the waterfall. What happens to these last few drops? You know, after all those complicated steps, the rule here is actually pretty simple. Whatever is left over at the very end, you take exactly half of it, and that amount gets included in your income for this year. So for Innovate Corp, they have $5,000 left. Half of that is $2,500, and that's their income inclusion. And this is the big punchline, everyone. Think about it. We started with a $40,000 economic gain, but after this whole multi-step process, only $2,500 of it actually gets taxed in the current year. That's it. The tax hit on the other $37,500 has been pushed off into the future. Which, of course, brings us to the most important part of this whole discussion, this strategy, or what I like to call the art of deferral. Let's wrap up by looking at the big picture here and why this all matters so much for tax planning. If you remember one thing from today, let it be this. These rules are about tax deferral, not tax forgiveness. This is so important. The government isn't just letting the tax on that gain disappear. They're just letting you delay paying it. That tax will get paid eventually, right? It'll get paid when you would have used those losses or when you finally sell that building with the reduced cost. The whole point of this system is to give a company that might be struggling some breathing room today by pushing that tax bill into the future when hopefully they're in a much better position to pay it. So I'll leave you with a question to chew on, something to test if you've really grasped the strategy here. Let's say you have a choice. Why might it be a way better long-term strategy to reduce the cost of a piece of land instead of, say, a company truck? Think about what we discussed today. We'll kick off our next class with that very question. Thanks, everyone.